Welcome back to the Deep Dive. We're the show that digs into your sources to really get to the heart of what you need to know.
We're here to make sure that time you spend listening gives you the absolute best return. Today, we are tackling a huge one.
A really huge one.
It's a concept that's, it's fundamental to building wealth over the long haul. But it's also, I would argue, the single most misused and misunderstood term in all of personal finance.
We are talking about dollar cost averaging.
We are.
Okay, so before we dive into the weeds, the definitions, the controversy, let's just ground this conversation in the sheer power of being consistent.
Yeah, the end goal.
Exactly. Our source material kicks off with this really stunning hypothetical. It just perfectly sets the stage. Imagine you decide, okay, I'm going to invest $500 a month.
Which is what, a car payment for some people?
Or less. Could be a coffee budget. But you do it every single month, automatically, for 40 years. And you get let's say, a pretty reasonable 10% average annual return.
Which is right in line with historical averages.
Right. At the end of those 40 years, your balance would be over $2.5 million.
It's an incredible number. And that's the thing to remember. That $2.5 million, it's not from some lucky stock pick. It's not about timing the market perfectly.
Wow.
It's a monument to a habit. It's just automated, consistent behavior. So the real question for, any regular person saving for the future is how?
How do you do it?
How do you actually execute that $500 a month investment in the smartest way possible? And critically, how do you maintain the discipline to do it for decades?
That's the key.
Yeah.
And the name for that method, dollar cost averaging, or DCA. You hear it everywhere. I mean, your 401k, your pension plan, it probably uses this exact strategy.
It almost certainly does.
But what we found, digging into the original sources, is that this term, this thing that's so widely debated, has been, it's been hijacked. It's been completely misinterpreted.
And often by the very industry that's selling you the investment products.
So our mission today is, it's very specific. We are going to strip away all that noise.
We're going back to the beginning. We're going to clarify what it originally meant, the precise math that makes it work, and then we're going to expose the so-called controversy around it.
A controversy that, as we're about to show, isn't actually about true DCA at all. It's about something else entirely.
Exactly.
And to do that right, we have to go back to the source. The term was first put on paper in 1949 by the absolute grandfather of value investing, Benjamin Graham.
In his book, The Intelligent Investor, which is, a foundational text.
It's the Bible of investing for many, so that's where we're starting. Let's define true DCA, the Graham principle.
Right. So Graham's whole project was to create strategies for the average person, the intelligent investor, not the Wall Street professional.
Someone smart, but not an expert who does this all day.
Exactly. And he defined DCA as a way to apply the principles of value investing.
Which usually involves tons of complicated analysis, right? Reading balance sheets and all that.
Tons. He wanted to apply that logic to the simple act of just putting money away from your paycheck.
So what was his specific definition? What's the core mechanic?
It's almost painfully simple. He said DCA means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter.
The same number of dollars. That's it.
That is the non-negotiable anchor of the entire strategy. The dollar amount is constant.
So it's not about buying, say, 10 shares of a stock every month. It's about putting in $500 every month, no matter what those shares cost.
Precisely. And that fixed dollar rule is, it's the behavioral genius of the whole plan.
How so?
Because the amount of money is fixed, your actions automatically work against the market's craziness. Think about it. If you're investing your $500 and the share price gets cut in half, say it goes from $100 to $50.
My $500 now buys twice as many shares.
You automatically buy double the shares. You load up. And if the price skyrockets, your $500 automatically buys fewer shares.
So it forces you to be greedy when others are fearful and cautious when others are euphoric, to use the Buffett line.
Exactly. But you don't have to think about it. The discipline is just built right into the system. It bypasses all that emotional decision-making that trips people up.
That consistency is huge. But the sources also get into the hard math behind it, why it's actually superior.
They do. But before we get to the formulas, let's just quickly talk about the name, because this is where the global confusion really starts to creep in.
DCA isn't the only name for it.
Nope. In the UK, you'll hear it called pound cost averaging. Makes sense.
Sure.
And in other contexts, you might hear unit cost averaging, incremental trading, or even the cost average effect. It's all the same core idea.
And just as important, the sources warn us what DCA is not.
Right. Even back then, Graham had to make this distinction. You cannot confuse his DCA, the fixed dollar plan, with something called a constant dollar plan.
Wait, okay, that's confusing. DCA uses a constant dollar amount. So what on earth is a constant dollar plan?
It's a great question, and the terminology is, frankly, not great. It's easy to mix them up. True DCA is all about your contributions, the new money you're putting into the market.
Okay.
A constant dollar plan, on the other hand, is a rebalancing strategy. It's about maintaining a portfolio. It means you decide you want to keep a fixed dollar value in an asset.
So, like, I decide I always want $10,000 worth of gold in my portfolio. If gold's price shoots up, my holding is now worth $12,000.
So you'd sell $2,000 worth to get back to your $10,000 target.
And if the price crashes, I'd have to buy more to get back up to $10,000.
Exactly. It's a risk management tool. It's about maintaining a specific allocation. DCA is about accumulation and growth from new income. They are operationally worlds apart.
Okay, distinction made, that's clear.
Okay.
Now let's get into the math. The sources bring up something called the harmonic mean. I think most of us remember the simple average, the arithmetic mean. What is the harmonic mean, and why is it the secret sauce here?
This is really the aha moment for true DCA. It's why the math is so powerful. You're right, most people just think of the simple average. You add up all the prices you paid and divide by the number of purchases.
Right.
The harmonic mean is different. It's a special type of average that gives more weight to the lower numbers in a set.
Why? What's the logic there?
Think of it in terms of rates. The harmonic mean is what you use when you're averaging rates, like, say, your average speed on a road trip with different speed limits, or in this case, the weight at which your dollars buy shares.
Ah, okay. So
Yeah.
because I'm investing a fixed amount of money,
Yes.
when the price is low, my money is working at a higher rate. It's buying more units.
Precisely. You're buying a higher quantity of shares at those lower prices. So those lower prices have this sort of gravitational pull on your overall average cost. They matter more.
And the key mathematical insight here is what?
The key insight is that for any set of numbers that aren't all identical, the harmonic mean is always lower than the arithmetic mean. Always.
So because the DCA calculation is based on this naturally lower average price, the harmonic mean, I mathematically end up with a lower cost per share than if I, say, bought a fixed number of shares each month.
Absolutely. It's a mathematical certainty. And this proves why DCA is superior to that, and more importantly, superior to just saving up your cash and trying to time the market with your regular income.
That last part is so important. If you just accept that, historically, markets go up over the long term.
Which is what all the data shows.
Then holding cash is a losing game. DCA gets your money working immediately in that upward trend, while the fixed dollar mechanism helps manage the scary short-term swings. You avoid that paralysis of holding cash, waiting for the perfect moment that never comes.
And that really sums up the whole theory of true DCA. It's a fixed dollar regular contribution strategy that uses the math of the harmonic mean to get you a better price over time, as long as you believe markets will grow.
Right. We get the theory, we get the math. Now let's move to segment 2 and talk about actually doing this. We need to push this elegant theory through the messy gears of the real world.
Right, the practical side.
We'll talk about how simple it is to set up, but also the one crucial detail that can absolutely torpedo the whole strategy if you ignore it. And that's the crippling drag of brokerage fees.
Yeah. Implementation is everything. And for true DCA, Graham's version, it really only requires 2 decisions from you, the investor.
Just 2.
Just 2. First, the fixed amount of money you're going to invest each period. That's usually just based on your budget, your income. And second, the frequency. How often are you going to invest it?
And that simplicity is, I think, its superpower. 2 decisions, you set it up, and you walk away.
Set it and forget it. No more agonizing over whether now is a good time to buy. You just automate the whole thing. Payroll deductions, scheduled bank transfers.
You just line it up with whenever you get paid. You get paid fortnightly, you invest fortnightly. Simple.
The psychological freedom that gives you is immense. You're no longer tempted to stop investing when the market looks scary or to pile in when it's euphoric. The discipline is automatic.
But, and this is a big but, the sources bring up this really critical and I think often overlooked problem: transaction costs. Now, today in the age of commission-free trading apps, a lot of people might not even think about brokerage fees. But for some assets or on some platforms, they still exist. And a fixed fee can turn this beautiful strategy into a financial disaster.
That's absolutely right. When you're buying something that has a fixed transaction cost, a flat $10 brokerage fee per trade, for example, the frequency of your investment suddenly becomes incredibly important.
Because if you're investing small amounts really often,
The drag from those costs can actually be bigger than the return you expect to make in that short period. It's like trying to run a race with an anchor tied to your leg.
death by 1,000 paper cuts. You're religiously buying every week, but that $15 fee is just eating away at your capital before it even has a chance to grow.
Exactly. Now, this isn't an issue if the fee is a percentage of your investment or if you're in, say, a managed fund with no explicit trading costs. But if you're buying individual stocks or ETFs and paying a flat fee, you have to do the math.
Okay, to really make this stick, let's walk through the exact example from the source material, because the numbers they're pretty stark.
Let's do it. So let's imagine an investor. They have $500 available every 2 weeks, every fortnight to invest.
Okay.
The brokerage cost is a fixed $20 per transaction, and let's say the expected annual return on the asset they're buying is 6%.
Got it. So scenario one, the investor is super disciplined. They stick to that fortnightly schedule, investing $500 every 2 weeks. What's the immediate damage from that fee?
Well, the fee is $20 on a $500 investment. You can do the math right there. That's 4%. 4% of your capital is gone instantly.
Wow.
Now compare that to your expected return. A 6% annual return broken down over a 2-week period is only about 0.23%.
Wait. So you are paying a 4% fee to try and capture an expected gain of 0.23%.
Yep.
The cost is almost 20 times higher than the expected return. That's not just a drag. That's a guaranteed loss on that contribution.
It is. It's a disaster. The DCA mechanism is trying to work, but the transaction cost is just completely overwhelming it. So the only way to fix this is to change one of your two variables.
Frequency.
The frequency. You have to invest less often, which means you're investing a larger amount each time, which makes that fixed fee a smaller percentage of your total.
Okay, scenario two then. Let's change the period. Instead of every 2 weeks, let's go to every 4 weeks. So we're investing $1,000 once a month.
Okay. The brokerage fee is still $20, but now it's on a $1,000 investment. So the cost drops from 4% to 2%.
That's a big improvement. Halved it.
It is, and your expected return for that 4-week period also goes up to about 0.46%, so it's better. But
But the 2% cost is still way higher than the 0.46% return. You're still starting in a hole.
you're still starting in a pretty deep hole. The lesson is that even if the theory of DCA is perfect, a bad implementation because of fees can make it completely ineffective in practice.
So what's the sweet spot? Where's the optimal point in this scenario?
Well, the source material actually runs the numbers and suggests that the optimum period is 10 weeks.
10 weeks. Okay, break that down.
So over 10 weeks, our investor would save up 5 of their fortnightly payments. That's $2,500.
And they make just one trade, one $20 transaction.
Correct. So that $20 fee on a $2,500 investment is now only 0.8%. Much more manageable.
And what's the expected return over 10 weeks?
The expected return over that 10-week period is 1.15%.
Now we flipped it.
Now you flipped it. The expected return is finally higher than the cost of the transaction. You're actually starting with a positive expectation.
This example is so powerful. It proves that real-world DCA isn't just about the fixed amount. That frequency decision is absolutely critical, and you have to calibrate it based on your transaction costs.
You have to. It's the difference between the strategy working for you and you just making your broker rich.
And that moves us perfectly from the practical details into segment 3, the great confusion. Because if true DCA is this elegant, disciplined, income-based strategy, then why is everyone always arguing about it? Why are there so many articles saying it's suboptimal?
This is it. This is the heart of the problem. The answer is that the entire modern debate has been corrupted by a profound confusion between true DCA and what we can call the windfall strategy.
Oh, windfall.
Yeah.
So a situation that is the complete opposite of a regular paycheck.
The complete opposite. We're talking about an investor who suddenly receives a large one-time lump sum of cash. Maybe it's an inheritance, an insurance payout, a big bonus from work.
So they have a pile of cash sitting there right now, and they need a plan for it.
And instead of investing it all at once, which is called a lump sum investment, or LSI, many investors get scared. And they choose to drip feed that windfall into the market over time, say over 6 months or a year.
That delayed, staged approach.
Is what Vanguard, which has done the best research on this, likes to call a systematic implementation plan, or SIP.
But that's not what the media calls it.
No. The media, the finance industry, marketing materials, they all just call it dollar cost averaging. And that's the original sin.
So why do people choose that SIP strategy? Why delay?
It's 100% driven by fear. It's the fear of timing risk.
The fear that you'll put your entire inheritance into the market on a Monday, and by Friday, the market has crashed 10%.
That is the nightmare scenario they're trying to avoid. They're trying to buy emotional insurance against that specific worst-case outcome. And on the surface, it looks a bit like DCA, right? Regular investments over time. But the source of the capital is completely different.
So we have two totally different things. True DCA, investing regular income over time to build wealth, and SIP, delaying the investment of a lump sum you already have to manage fear.
They look similar, but their purpose, their starting point, their whole mathematical context, it's night and day.
And the sources point out how persistent this mistake is.
Yeah.
Even at the highest levels.
It's incredible. You mentioned Vanguard. They published a fantastic research paper that explicitly made this distinction. They said, look, our SIP strategy for lump sums is not the same thing as true DCA for regular savings.
They drew a clear line in the sand.
They did. But then what happened? In other more client-facing brochures and articles, they went right back to calling the delayed windfall strategy dollar cost averaging.
Why? Is it just easier? Laziness?
It's probably a bit of both. Once a term gets into the public consciousness, it's really, really hard to correct it. It's easier to just use the term your clients think they understand, even if it's technically wrong.
This is the big reveal for our listeners. If you're reading an article today that's debating the pros and cons of DCA, there is a 99% chance they are not talking about your monthly 401k contribution.
They're talking about what to do with a big inheritance, and the math for those two situations is completely different.
And it's not just cash windfalls, right? The sources say the same confusion happens with big portfolio changes.
Yeah, another great example. Let's say you're an investor, you're pretty conservative. You have 80% in bonds and 20% in stocks.
Okay.
And you decide, you know what? I need to be more aggressive. My plan says I should be at a 50-50 split.
So you've made the intellectual decision. The allocation needs to change now. You need to sell a huge chunk of bonds and buy a huge chunk of stocks.
But then that fear kicks in again. What if I make this huge shift today and the stock market crashes tomorrow?
Timing risk.
Timing risk again. So instead of just ripping the Band-Aid off and making the trade, they decide to stage it. We'll shift 5% this month, 5% next month.
Which totally defeats the purpose of the original decision. You decided you needed more stock exposure today, but your fear is making you delay getting that exposure.
In every one of these scenarios, the driver is fear of short-term regret. And the tool they use to manage that fear, the staged investment, the SIP gets mislabeled as DCA.
And that mislabeling obscures the beautiful, simple strategy Graham actually created for regular savers.
Which is what we need to get back to. Understanding this distinction unlocks the entire modern debate, which brings us to segment 4. We're talking risks, benefits, and the surprising power of behavioral psychology.
Right. So we've established that for true DCA Graham's DCA, using your income, the math is pretty solid. If you expect markets to go up in the long run, it beats hoarding cash.
It does, though we should acknowledge the contrarians. The sources do note that you'll find advisors like Suze Orman who are huge champions of DCA, but you'll also find others who dismiss it. They call it a marketing gimmick.
But this is where that confusion does real damage, because almost all of that negative chatter is aimed at the windfall scenario. And it leads to this really misleading headline conclusion that DCA is suboptimal.
That is the suboptimality trap. The entire public debate is about SIP versus LSI. It's about the windfall. And the shocking discovery that researchers have made is that SIP is often mathematically worse than just investing the lump sum immediately.
Okay, let's get into that. Why is investing the lump sum all at once usually better? What does the data say?
The Vanguard modeling on this is the gold standard. They looked back through market history and compared the two strategies. What they found was that investing a windfall immediately, the LSI approach, outperformed the delayed systematic approach, about 2/3 of the time.
2/3. So 66% of the time, the person who was brave and just put all the money in at once ended up with more money.
A lot more in some cases.
Why does delaying face such a big statistical headwind?
It's just opportunity cost. It's the cost of holding cash. If you believe the market has a positive expected return over time, that it trends upward, then every single day your windfall is sitting in cash is a day you're missing out on that expected gain.
You're betting against the long-term trend.
You're knowingly choosing to invest at a future date, even though you expect prices in the future to be higher than they are today. That cash isn't just waiting, it's losing purchasing power to inflation, and it's missing out on compounding.
You're giving up a very likely higher return in exchange for protecting yourself against a less likely immediate crash.
Mathematically, that's not a great trade most of the time.
And this leads us to the real disservice this confusion does to the regular investor. The valid criticisms of SIP, that it's mathematically suboptimal for a windfall, get misapplied to true DCA.
This is the real danger. The average person saving for retirement is using DCA exactly as Graham intended. They're not dealing with a windfall, they're just investing from their paycheck.
But then they see a headline, why dollar cost averaging is a bad strategy, and they think it applies to them.
And the consequences of that misunderstanding can be absolutely disastrous.
That's the worst case scenario.
They might think, oh, I shouldn't be investing automatically. I should be timing the market with my savings. So when the market starts to fall, they do the worst possible thing. They stop their retirement contributions. They say, I'll wait for the bottom.
Which completely defeats the purpose of true DCA. The whole point is that you keep buying on the way down.
Yeah.
That's when you acquire the most shares. That's when the harmonic mean really works as magic for you.
Exactly. Confusing Psyche's problems with DCA strengths can lead people to abandon the single most reliable path to building wealth that exists for the average person.
Okay, so we've established the math. For a windfall, LSI wins 2/3 of the time. But let's be human for a second. If you put $50,000 in the market on Monday and by Friday it's worth $45,000, that feeling is just gut-wrenching.
It's awful.
Do the sources talk about that psychological reality? Why would any smart advisor still recommend the systematic, delayed approach?
They do, and this is where it gets really fascinating. We have to shift from pure math to behavioral economics. And the answer is that some advisors advocate for SAP specifically as a behavioral tool.
A behavioral tool? What does that mean?
It means for certain investors, the fear is so paralyzing that they would never invest the lump sum at all. They'd just let that $50,000 sit in a checking account, getting eaten by inflation forever.
So the real comparison isn't SIP versus the mathematically optimal LSI. It's SIP versus doing nothing.
And in that comparison, SIP wins by a landslide. A slightly suboptimal plan that you actually execute is infinitely better than a perfect plan that you're too scared to act on.
SIP allows the investor to manage something the sources call the asymmetry of regret. Explain that.
It's a known psychological bias. Studies show that the pain we feel from a loss is much stronger than the pleasure we feel from an equivalent gain. And for investing, it means we feel much, much worse about investing a lump sum and seeing it immediately fall.
The regret of a bad action. I made a terrible mistake.
Exactly. That feels way worse than the regret of missing out on some gains because we invested too slowly.
The regret of inaction. That feels less personal.
It's less acute. You blame the market, not yourself. SIP is a strategy designed to minimize that painful, immediate regret of a big loss. If the market crashes right after you start, you're relieved you didn't put it all in. If it soars, well, you're still participating. Your regret is diluted.
So it's a form of emotional control. It takes that one massive, high-stakes, emotional decision and breaks it down into a series of smaller, unemotional, automatic ones.
It puts the plan on autopilot and gets the money off the sidelines. The mathematician in the room sees lost potential return. The behavioral psychologist sees a successful investment that actually happened.
So if an investor decides, look, for my own sanity, I have to use the delayed approach for my windfall, is there any guidance on how long that delay should be?
Yes, there is. One study looked at exactly this question. It tried to find the sweet spot, the best time horizon that balances the risk and return trade-off.
What did it find?
It found that if you're going to delay, the optimal windows are either 6 or 12 months.
6 or 12.
Right. Anything longer than a year, and the odds of you missing out on significant gains just become too high. The opportunity cost starts to overwhelm the psychological comfort.
That's a great practical piece of advice. It puts a reasonable boundary on it.
It does. And it just reinforces the whole point. This entire debate about suboptimality is about managing fear around a rare, one-time event. True DCA is about managing the process of regular saving, using consistency to win over the long term.
This has been such an important clarification. We've really dissected the term dollar cost averaging, and I hope restored it to its original powerful meaning. Let's just bring it all home, crystallize the key takeaway here.
Let's do it. We started by saying DCA is widely misunderstood, and the misunderstanding is all about mixing up a recurring saving strategy with a one-time investment strategy.
So to be perfectly clear, true DCA, the Benjamin Graham version, is for your recurring contributions from your income.
It's the engine of your retirement plan. It's consistent, it's reliable, it uses the harmonic mean to get you a better average price, and it's mathematically your best bet if you believe markets go up over time.
And the whole controversy, all the articles about DCA being suboptimal.
That almost always refers to the Systematic Implementation Plan, or SIP, using a staged approach for a lump sum.
An approach that is statistically worse than investing it all at once about 2/3 of the time.
But which can be a very powerful behavioral tool to overcome fear and actually get the money invested.
So the key takeaway for you listening right now is simple. For your regular contributions, for building that $2.5 million nest egg from your salary, the automatic, consistent, fixed dollar nature of true DCA is the soundest method there is.
It takes the most dangerous variable out of the equation. You trying to time the market.
Okay, so let's end with a final provocative thought.
Yeah.
It builds on this behavioral side of things we've been discussing. We've just established that the biggest criticism of this whole concept stems from a situation getting a big windfall. That's actually a pretty rare event for most people.
Right. Most people's financial lives are about regular income, not lottery wins.
So the core job of any good investment strategy isn't just to be mathematically perfect in a spreadsheet. It's to encourage a habit. It's to keep you investing consistently for decades.
Execution is everything.
So we have to ask, if the ultimate goal is just to get money out of cash and into the market to grow, is a strategy that helps someone simply start, even if that strategy, like SIP for a windfall, is slightly suboptimal in hindsight, is that actually more valuable for human success than a perfect strategy that an investor is too afraid to ever execute?
That's the question, isn't it? It's the tension between what's optimal on paper and what's possible in real life. And bridging that gap is maybe the most important part of investing.
We have defined, clarified, and I hope rehabilitated the concept of dollar cost averaging. Thank you for diving deep with us.
We'll see you next time.